Hi, my name is Jeff DeWeese, and I'm the Chief Investment Officer at Oric Capital Partners. Today, we're going to talk about asset class correlations and why they're important to your portfolio's construction. Asset class correlations measure how different types of assets move in relation to each other. Understanding these correlations is crucial for portfolio diversification and risk management. Some common asset classes and their typical correlations include stocks versus bonds. Generally, stocks and bonds have a low to negative correlation. When stock prices fall, bond prices often rise as investors seek safer investments. This isn't always the case, though. In times of financial crisis, correlations may increase as both asset classes experience simultaneous declines. This happened as recently as 2022. Stocks versus commodities. Stocks and commodities typically exhibit low or negative correlation. Commodities like gold often act as a hedge during stock market downturns. However, there are some years like 2024 when they're both highly correlated and they both went up at the same time. Stocks versus cash. Stocks and cash have a strong negative correlation. During market downturns, investors tend to move to cash equivalents for stability. Lastly, bonds versus commodities. Typically, bonds and commodities have a negative correlation. Rising inflation, which benefits commodities, tends to hurt bond prices due to rising interest rates. We often tell clients that if there's not something in the portfolio that you hate, then we're not properly diversified. If everything in your portfolio is going up together, there's also a pretty good chance that it could all go down together. Some of the correlation diversification strategies that we use here at Oric include investing across different sectors: technology, healthcare, finance; geographic diversification, US, emerging markets, Europe; large cap and small cap stocks; different types of bonds, government, investment grade, high yield corporates, floating rate; short and long-term maturities; various commodities, oil, gas, gold, silver, wheat, corn. We also allocate to alternative investments: private equity, private debt, and real estate, global macro, managed futures, just to name a few strategies. All of these diversification strategies, aligned with a strict rebalancing policy, allows us to take profits when one asset class is outperforming and add to another that is lagging. Over time, this allows us to have more consistent returns without as much volatility. Volatility can never be eliminated, but it can be reduced. This helps people stick with an important rule in investing: to stay allocated. As always, stay calm, stay diversified, and stay positive. From all of us at Oric Capital Partners, we wish you all a great day.